Hi, Andrew Cooper here, Advice for Living Financial Planning. Just 5 things today, and I'll try and keep them fairly short. The first one is that we've experienced some problems recently with emails, possibly because our new staff member, Vereen Tan, who will be looking after insurances for us, has had trouble with emails going to people's spam. So maybe it's because she's just new and possibly the system's not recognising it as a genuine email. So if you are expecting something from us, can I ask you please do check your spam or junk folder, because it may well have gone in there. Second thing is also in terms of issues which are annoying, is that as of the 1st of July, the federal government has changed some more rules yet again, and has required that for advisor fees, that's the fees that you pay us for our service, where these are drawn from your product. So like if you've got, for example, a Colonial or a Net Wealth pension and our advisor fee is coming out of that, then we have to have not only our advice document, which says, yes, okay to charge an advisor fee, we also now have to have a form from that provider. So if you're with Colonial, then there's a Colonial form that we'll have to sign, and likewise Net Wealth will have a Net Wealth form to sign and that sort of thing. So apologies for that. Something else to sign. It doesn't improve our service in any way. It's no benefit to you. I don't know why they have to do it, but apparently that's the requirement. So when we do have your next review, I'm afraid there will be a new form to sign about that. So apologies for that. On the subject of changes, the government made yet another last-minute change, this one for pensions, superannuation pensions. You might recall that for those of you who were on superannuation pensions, last year the federal government said that because of the COVID issues, they were halving the minimum amount that you had to draw from your pension. So you didn't have to halve, but if you wanted to, you could draw up to half of your pension. And they said that that would finish on 30 July this year. Only a couple of days before the 30th of July, they changed their mind and said, oh, we're going to extend this for another year. So if you were on the minimum last year and you're on that half amount, that will continue for the next year unless that's annoying you. So if it's not enough, if you're not getting enough, then do please contact us and we will set a new amount for you in place. If you were on a set amount last year, then that will continue. So it won't change. It's only if you were on the minimum, on the legislated minimum, that it will affect you. So short story is most of you will start getting pension payments for July in the next couple of days. So if the pension payment comes and he goes, hang on, this is not enough, then please give us a call and we can make that adjustment for you. Another quick item I wanted to touch on, just as a reminder, for some of you maybe know, some don't, that if you are looking to provide, if there's someone you know who you have to put into aged care and you've got some issues with that, then our practice is accredited to provide aged care advice. The government again has legislated so now that only financial planners who have the additional qualification in aged care can provide advice in that aged care space. We have that accreditation, and so we can actually provide advice in aged care. So if you do have someone who is going to aged care and you're worrying about the money and do we sell the house or don't we, and all of those sort of things, we can provide advice on that and provide you with a strategy to get the best outcome out of the placement of that person or people into aged care. Last thing I wanted to touch on was share markets, and for those of you who may have been watching them, share markets have been going nuts, and the more nuts that they go, the more worried I become. Share markets have had a tremendous increase over the last 12 months, obviously off a low base because things went bad last year, but the share markets, well, in many places around the world, are reaching record levels. The New York Stock Exchange reached its highest ever level last night, and that is concerning because the share market is, in many ways, has broken up into two bits, as it were. There are, at the bottom end here, there are the companies that actually make things, make money, make profits, and pay dividends. Generally, a lot of these companies are sitting at levels which are reasonable given their amount of profit, because that's really what drives sustainable growth in the share market, is that the share price is governed by the amount of profit that the company is making. So for those ones, for the companies that are doing dull stuff, that is fine. The trouble is for the sexy stocks, your Uber, Netflix, and Amazon Prime, and a lot of these tech companies and that sort of stuff. There is a problem with them because their share price is going nuts, but the profits aren't following. Some of them are making no profit. I mean, the people at Uber said they will probably never make a profit, and yet the share price has gone nuts. That is not sustainable. So what is inevitably going to happen is there will be a share market correction, and the trouble is with share market corrections is that markets go either way too far. So they go up too high and they go down too far. So we should expect a correction at some level. I'm hoping it's a fairly gradual one, but I think a correction is inevitable. While I am concerned about that, for those of you that are in accumulation, you're building towards retirement, then that's probably not a big issue because you can wait it out and you know, the market will recover as it always does. For those of you that are in pension, we normally have a good sized bucket of cash, and so you can wait out a market correction. As I said, I don't know what it's going to look like. I hope it will be given that it's inevitable, I'm hoping it will be a fairly gradual correction, but we will just see. We can't wait, we can't know. What's going to happen though is as the share prices become increasingly unsustainable, eventually large numbers of people are going to start selling off to take profit, and once that sell-off starts, then the market tends to go down. Also, as interest rates go up, and we're already starting to see that happen, then inevitably that will put pressure on prices, because particularly professional investors are about where can I get the best return. Sure, you might be getting great returns in terms of growth, but if there's no income, then maybe if interest rates start to go up, and they can go, well, you know, I'm getting maybe a 1% dividend from my shares, but I can now get 2% from a fixed interest investment, then maybe they're selling out and down it goes. So all I'll say is don't be surprised. Don't wake up when we go, oh, shock horror, the share market's fallen. It is that will happen, and it's just a matter of when. If you have any concerns, do please give us a call, and we will ensure that people's, you know, your portfolio is in the best place it can be. I'm confident that most people are in a good position to mitigate whatever issues come. But we can happy to discuss that with you. So this is much longer than I expected. So if there's, as I said, if there's any issues, any concerns, do please give us a call, and we'll be happy to assist. Thanks so much. Have a great day.